Okay, welcome back. Now we're getting into, talked about money, we're going to get into the banking system, okay? And as we talked about before, excuse me, a bank is a financial intermediary um, between the borrowers and the lenders, all right? Now, when we talk about a business, well, if a business is going to go and borrow money, typically they will do so through their long-established uh, history with their bank. Okay, so the bank is number one. It is a financial intermediary. Okay, but number two, we see it. It is a creator. This banking system is a creator of actual money, okay, by way of what they call fractional reserve banking. Now, as you all know, a bank at any one time, doesn't have all its deposits, in the vault. It can't, because, just ask yourself, what does a bank do? Nothing special. It doesn't make cars, doesn't make trucks, it makes loans. And that's what a bank does. Okay, that's how they stay in money. That's how they stay in business. Okay. Now there were some reforms after the 1930s. We just looked at the Great Recession, the Great Depression. I'm sorry, and we had all these little banks folding up, people losing their life savings. The times were really, really bad. So they came up with these four reforms, and the number one is the FDIC, the Federal Deposit Insurance Corporation. That guarantees your money in a bank, it's $250,000, and it just made everyone feel a lot safer having their money in a certain bank. If something happened to that bank, your money was protected. So that went a long way to eliminating what they would call bank runs. And as I think I mentioned, classic bank run was in the movie It's a Wonderful Life that you typically see around Christmas time. All right, so after that, they also said, okay, we also want you to have a little cushion over and above what what normally you need to have. We would like, and there's different formulas. Basically, it comes down to they want you to keep 8% above, as part of your capital requirement as a cushion. Okay. Just in case something happens, you've got that little buffer, 8% extra capital, over everything else, that will help and also make folks have more faith and trust in you as well. Okay, number three was the reserve requirement. There is a certain amount that a bank always has to maintain either in their vault or in the vault at the Federal Reserve, okay? And that reserve requirement can change, and that's actually one of the tools of the Fed. We'll get into it in just a minute. All right. Number four is the discount window, which is another tool that the Fed uses. The discount window, I always thought there was kind of a funny name, banks would borrow at the discount window from the Federal Reserve. But it always sounded to me a little like you're sneaking down an alley and you're looking for the discount window and you find it and you need to borrow $200 million for 3 days or something. Anyway, the discount window is where the federal banks will borrow from the Fed and the interest rate is, oddly enough, called the discount rate, okay? And I don't know why they call it the discount rate, and we'll get into that in just a minute, okay? Now, what do we have to remember, though? Well, if the discount and the reserve requirement right now is 10%, with the reserve requirement of 10%, well, is the bank going to have all its money, in the vault? In other words, if all of us went to a bank that we had our money in, all the depositors went at the same time, could a bank pay them? Well, no, they couldn't, because there's no way they would be able to stay in business if they had all the money in their bank. Bank stays in business by making good loans, okay? They consider that an asset, a good performing loan, all right? So they want to make a lot of them, all right? So technically, if you want to look at it in that respect, at any given moment in time, there's not a bank in the country that is totally solvent, meaning they couldn't pay off all their debtors all at the same time, all right? But I mean, that's just the nature of the beast, so to speak. All right, so what is this fractional reserve banking, and why is it so important? What does it do to an economy? Well, we have banks. Let's say we have 3 banks here, and let's say we start in we'll go back. Let's say we go back a few hundred years, and we all live in a little town, and none of us have any money. I mean, we're not exactly happy, but none of us have any money. There are 3 banks in the town. Anyway, one of you comes to town one day, and you've got a stranger comes to town and is going to move into the town and has $10,000 with them. Wow, that's great. So what happens? Well, this welcomed stranger comes in, settles in our town, and he puts the $10,000 in bank number 1. Now the bank is liable to that person for the money, so it takes the $10,000 and it lists them under liabilities, okay, because it is liable to them for the money. And then on the other side, we see its assets. Well, it knows it has to keep 10% as a reserve requirement. So 1,000 of that 10,000 stays in the bank, all right? But the bank can loan out the other 9,000. And let's say one of us is a real good credit risk, okay? And you go and you get a loan, you get that $9,000 loan, all right? Okay, now what has happened? You take the loan to the second bank, all right? And you put the 9,000 in the second bank. What has just happened, okay? Well, in just one transaction, we almost doubled the money supply of our town, okay? Now granted, the stranger coming in with the 10 started the ball rolling, but we were at 10,000, all right? But after that one loan, if you were the one who borrowed it, and I asked you, you borrowed that 9,000, I said to you, hey, how much money do you have in the bank? And you say, well, I've got 9,000 in bank number 2, all right? And our original person who came into town has 10, so now we have $19,000, in our town. We almost doubled the money supply with just one transaction. Now, and this doesn't stop there. It turns over again and again. Bank number 2 can't just sit with the money. So bank number 2 says, okay, we're going to take the 9 and we're going to hold 900 of it, as a reserve requirement. They'd love to loan out more, but they'll do this. So then they take the 8,100 and they loan it to someone else, to another one of you. And you get that 8,100 and you go and put it in bank number 3. Well, now we've got $10,000, $9,000, $8,100, and bank number 3 is not finished. They're gonna they're going to loan it out to someone else. They have to, again, keeping 10% all the time as a reserve requirement, but they're going to loan it out again. So look what has happened. Like I said, look what happened with just one transaction. One transaction, we almost doubled the money supply. And you say, well, okay, where will it end if we keep doing it in this fashion? Well, at a 10% reserve requirement, in other words, every bank holding on 10%, loaning out 90, holding on 10, that money, that initial $10,000 will eventually grow to $100,000, okay? Excuse me. That is the power of fractional reserve banking. And the multiplier, remember the multiplier? Well, in this case, the multiplier is 1 over whatever the reserve requirement is, okay? So it's 1 over, our reserve requirement was 10%, okay, so it's 10%. So it's 1 over 1/10. And again, as I said, you flip the fraction if it's there, and so our multiplier is 10. So whatever you started with, it will be multiplied by 10 times. You end up with 100,000. Now, can the Fed play with this reserve requirement? Sure. And it can raise it or it can lower it, okay? If the Fed said, well, I don't know, 10% doesn't really seem like enough. Maybe we're too aggressive. Let's be a little bit more conservative. Let's make the banks hold 20%, okay? Now, you as bankers wouldn't be happy because now you can only loan out 80% of the funds that you receive, okay? And you have to hold the 20%, in your vault. But what happens? Well, in this case, raising it to 20%, what happens to the multiplier? Well, it would be 1 over 20%, okay? Or not 1 over 1/10, but 1 over 1/5. So you flip the fraction, and that 10 would turn into a 5. So if you went from a 10% reserve requirement to a 20% reserve requirement, the money would be multiplied by only 5 times instead of 10. So that 10,000 would become 50,000, all right? And yes, the Federal Reserve can adjust this reserve requirement, and does, as part of our monetary policy that we're going to be talking about in just a minute. Okay? All right, so let's move on. All right. And we're moving on to monetary policy and the Federal Reserve, the Central Bank of the United States. All right? Let's see. That's straight, I hope. All right. Central Bank of the United States, all right, the Fed, is in charge of our monetary policy. It is in charge of regulating the banking system as well, okay? But it pretty much runs our monetary policy. And just like when we talked about, fiscal policy, which remember was government spending, government taxing, and transfer payments, fiscal policy can be expand an economy or contract an economy. Same thing with the monetary policy. It can be expansionary or it can be contractionary, okay? Now, there's a lot of argument for the fact that, oh, well, when it's all said and done, they'll increase or decrease the money supply. That's only short term, but in the long term, things will adjust and we'll get back to normal. The debate for that is still goes on. So we will say this, all right? At least let's look at it in the short run. In the short run, we increase the money supply into the economy. It's going to grow the economy, okay? At least in the short run. And the question is, how long before everything, adjusts and we get back to, where we were at just a different price level? Well, that's up for debate. So, like John Maynard Keynes says, perhaps we will get back to equilibrium in the long run, but we live in the short run. So we'll look at this. We'll keep that in the back of our mind, okay? But monetary policy can be expansionary and contractionary, and it really just boils down to the simple principle we talked about before. When what were we talking about at the very beginning of the semester? Price and quantity, okay? And if you have a lot of something and you're getting more and more of it, its value to you, its price to you, will tend to go down, okay? However, if that commodity or that good starts to become a little more scarce, okay, smaller and smaller, it becomes more valuable to you, and typically its price will go up, right? That is pretty much monetary policy, okay? We can, increase the money supply, which will, have an effect on the interest rate, or they can change the interest rate, which will also affect the economy. So the tools are the supply of money and the price of money. And is it neutral in the long run? That's typically what they call it, okay? We'll just say, all right, eventually we could say money is neutral in the long run. But it makes one heck of a big difference in the short run. So we'll be looking at it at least short term with the proviso that, okay, yes, in the long run, it would tend to be neutral, okay? All right, so number one, the Fed, in running monetary policy really has four basic tools. Guaranteed question on the test, and this fourth one is not in your book, so write it down. This is in real life. I lived it. I saw it happen in Washington, D.C. All right, first one, the most important tool of the Federal Reserve System is called open market operations, okay? And open market operations, well, what the heck is that? You say, well, you got the Fed. Now, and again, let me back up for a second. The Fed is also called the banker's bank and the bank of last resort. And we'll get to that in just a minute, okay? So open market operations. Okay, so here we have our economy. And again, just remember, with the idea, pumping money into the economy, it's going to expand the economy. All right? If we start taking money out, just like, greasing the gears of a fine machine, it's going to run better, faster, smoother. But you start taking the oil or the grease out, it's going to start running hotter and slower. Same thing with money. You pump money into the economy, it's going to grow. Okay? You pull money out, and it's going to contract. So we have the Federal Reserve, and the Federal Reserve has what they call T-bills, Treasury bills. Okay, and Treasury securities or Treasury bills are they're typically government bonds. Don't pay very much, but of a very, very, very short duration. I'm talking, a very, very short duration, maybe a week, 2 weeks, something, very, very quick. So they're Treasury bonds, low interest rate, almost as close as you can get to actual money in terms of liquidity. I mean, they're almost money, okay? But they don't pay much interest, and they're very, very, very short term. bonds, okay? Now, Fed's got a lot of these, and the Treasury's standing by to print them more if need be, okay? So, what happens if the Fed says to the banking system, here's our banking system, hey, you know what? We've got a bunch of these Treasury bills. We're gonna sell you, these Treasury bills, okay? And I mean, they're as good as cash to the banks. So the banks say, oh, okay, Treasury bills, huh? That sounds pretty interesting. Okay, so we'll do that. And if the bank sells Treasury bills to the bank, what happens? Well, it sells the Treasury bills to the bank, okay? And the bank buys them. So the cash comes into the Fed gives the Treasury bills to the banking system. Now just remember, here we have the cash going out of the banking system and coming into the Fed. So that would contract the economy, okay? But the Fed could also do the opposite. It could say, you know what, to the bank, we want to buy, you got any Treasury bills? We want to buy $500 million worth of Treasury bills. And it does, okay? So the banking system sends the Treasury bills to the Fed, but the key is that the Fed pays for these, pays the $500 million, and the cash goes into the banking system. That is expansionary. So when we have money going out into the system, as it is here, it expands the economy. If the Fed's pulling money out of the system, then it's contracting the economy. Okay? So we'll do one more time. If the Fed's buying Treasury bills, it's giving the banking system cash. That expands the economy. If it sells Treasury bills to the banking system, then it's pulling cash out of the system. That's contractionary. All right? Okay. So they can do either or. Again, expansionary or contractionary. And as the old saying goes, the Treasury issues the debt, meaning the Treasury securities, but the Fed actually monetizes it. That's an old saying. Okay, number 2, the reserve requirement. All right, well, the Fed, as we were talking about before with the banking system, it can set that reserve requirement. It's at 10% now. All right? Now, but if it raised it to 20%, that's less money the banks can loan out into the banking system. Into the economy. All right? So a higher reserve requirement, less money going out, it's going to be contractionary. If it lowers the reserve requirement, the banks are freed up to loan out more money into the economy. All right? So adjusting or removing that reserve requirement can change, expand or contract the economy. Okay? Number 3, the discount rate. Well, let's say you're all bankers. You're all ahead of your individual banks. You're all doing pretty well, and it's 10 to 5, and you're the president of the bank, and your controller comes in and says, "Hey, guess what? We're $100 million short of making our reserve requirement." And you go, $100 million? Yeah, that Coca-Cola check for $350 million. It's coming in 2 days. It's not here now. So you don't panic. What you do is you call your friends that you probably play golf with or something else who are presidents of the other banks, and you borrow in the federal funds, at the federal funds rate, okay, in the federal funds market. And banks do this all the time. There are massive amounts of money that move around at night, okay? And you'd call one of your friends and say, hey, look, I need 100 million. I don't need it for, we're not in any trouble. I need it for 2 days. And, your other president friend says, okay, no problem, I'll wire it over to you. So they do. And so you get the 100 million, for the next 2 days, and you cover your reserve requirement, okay? So that's borrowing in the federal funds market at the federal funds rate, okay? Now, let's say 6 months go down the road and you run into this thing again. Now it's 200 million you need, okay? Well, you call up your friends and gee whiz, all of them have just made their reserve requirement. And nobody can help you. Where do you go? Well, you go to here, the banker's bank, the bank of last resort. You go to the Federal Reserve System. And you go to the discount window and you borrow money at what they call the discount rate. Now that's always been interesting to me because you didn't go there first because the discount rate, guess what? It's more than the federal funds rate. It can be, it can vary, but it can be anywhere from 1/4 of a point to a whole point more, the discount rate, than the federal funds rate, okay? Now, you don't need it for a long period of time, but typically it's pretty large amounts of money. I mean, you're moving, tens, hundreds of millions of dollars sometimes. Not for very long, maybe for a few days, couple of days, okay? But even at 1/4 or all the way up to 1%, that really adds up. So you borrow from the Fed at the discount window at the discount rate, which is higher than the federal funds rate, which is why you went to the federal funds market in the first place, okay? Now, the last one is called moral suasion. The Fed uses this all the time. If you watch the movie Too Big to Fail, you will see the head of the Fed and the Treasury Secretary and the young woman who portrayed the head of the FDIC. You will you see them using moral suasion a number of times in this movie, okay? Moral suasion, this happens in Washington, D.C. all the time. It's another word for polite arm twisting is moral suasion. And this happened actually in the with the banking crisis when they were trying to save Lehman Brothers from going under. They called in all the big banks. And I got to remember, these heads of these big banks, I mean, they are maybe not quite billionaires, but they're multi-millionaires. And they're not used to being told, what to do. They're not used to having somebody say, hey, you're going to New York, you're going to the Federal Reserve in New York, and you're going to spend the weekend there, and you're going to figure out a plan to save this company, okay? So they brought this up to all these banks, and, they said, this is not an absolute order. But it was really well done in the movie. And they said, but we will remember whoever one of you doesn't come to New York, doesn't come and try to help out. We'll remember you. That's moral suasion. You don't have to do it, but oh brother, you're going to be really, really, really sorry if you don't, okay? And that is a tool, and they use it in real life, in reality. I try to give you some real life experiences all the time. Not in your book, but it's in real life, okay? All right, okay. Again, okay, we talked about this. Money neutrality. Folks say, okay, pumping money in is going to stimulate the economy, and taking money out is going to contract it. But eventually, money is going to be neutral, and things will adjust. Yeah, that is so. But the question is, how long does it take? Okay. Now, for instance, if the government needed, we're going into the, let's say, November elections, and if the government needed an extra $500 million, they're probably not going to want to cut spending, especially with the way things are now. I mean, it's a real toughie right now, and they're definitely not going to want to increase taxes. Okay, but if they absolutely need $500 million, what's their best option? Well, they can increase the currency by 500 million. Okay. Couple of nice things will happen. You pump that much money into the economy, and guess what? It is going to heat up. It is going to help. Now, will it eventually cool down? Yeah, but it might not be. It might not be for what, 7, 8, 9, 10 months. And by that time, none of us are going to have figured it out that, hey, we got this inflation. What happened? Oh, that happened back in October when they increased the money supply. So it is a very valuable tool that governments use all the time. Okay. Okay, we're going to wrap this one up. We'll go on the exchange rates and keep your money strong and weak and all that good stuff on our next clip. Okay. All right, everybody, be good.